Can SoFi stock really reach $50 per share? That's a question many investors are asking as SoFi continues to grow its member base, expand its banking business, and push deeper into financial technology. A move to $50 would mean more than tripling SoFi's current valuation. While some bullish investors believe it's possible by 2030, Wall Street remains much more conservative. So, what would actually need to happen for SoFi to hit $50, and what could stop it? Let's break it down. SoFi has transformed from a student loan refinancing company into a full-service digital financial platform. Today, the company offers checking and savings accounts, personal loans, investing services, credit cards, mortgage products, and technology solutions for other financial institutions. This diversification has helped SoFi become one of the fastest-growing fintech companies in the market. But rapid growth alone doesn't guarantee a $50 stock price. The key question is whether SoFi can continue growing earnings fast enough to justify a much higher valuation. Let's start with the optimistic scenario. Management has outlined ambitious long-term goals, targeting approximately 38% to 42% annual adjusted earnings per share growth over the coming years. If SoFi successfully executes its strategy, earnings could potentially reach the $2 to $2.30 per share range by 2030. That's important because stock prices generally follow earnings growth over the long term. At the same time, SoFi is expanding beyond traditional lending. The company is investing heavily in higher-margin businesses such as financial services, technology platforms, digital banking, and enterprise solutions. These segments could generate stronger profit margins than lending alone. Another major catalyst is member growth. SoFi continues to add millions of new members every year. As the customer base grows, the company gains more opportunities to cross-sell products such as banking, investing, loans, and credit cards. This creates a powerful ecosystem effect where one customer can generate revenue from multiple services. If SoFi can maintain strong growth while improving profitability, investors may eventually view the company more as a technology platform than a traditional bank. That shift could lead to a higher valuation multiple, which is a key requirement for a $50 stock price. In the best-case scenario, strong earnings growth combined with multiple expansion could make a $50 share price achievable by the end of the decade. Now let's look at the risks. The biggest challenge is valuation. Even if SoFi grows earnings significantly, a $50 stock price would still require investors to pay a relatively high multiple for those earnings. Historically, financial companies rarely maintain extremely high valuation multiples for long periods. Another risk is the broader economy. SoFi's business is sensitive to interest rates, consumer spending, employment levels, and overall credit conditions. If the economy slows down or enters a recession, loan demand could weaken and credit losses could increase. Competition is another concern. SoFi faces competition from major banks, fintech companies, and online financial platforms. Maintaining high growth becomes increasingly difficult as the company gets larger. Finally, execution risk remains. To justify a $50 valuation, SoFi must continue growing rapidly while successfully scaling its newer businesses. Any major slowdown could cause investors to lower their expectations. While retail investors often discuss ambitious long-term targets, Wall Street analysts are generally more cautious. Most analyst price targets for the next 12 months remain significantly below $50, often falling in the high teens or low 20s. This doesn't necessarily mean analysts think SoFi is a bad investment. Instead, it reflects the uncertainty involved in forecasting rapid growth many years into the future. Analysts typically focus on shorter time horizons and prefer to see consistent execution before assigning higher valuations. So, can SoFi reach $50? The answer is yes, but only if several important things go right. The company needs to maintain strong earnings growth, successfully expand its high-margin businesses, continue adding customers, and convince investors that it deserves a premium valuation. If those conditions are met, a $50 share price by 2030 is certainly possible. However, investors should remember that this represents a bullish long-term scenario, not a guaranteed outcome. Economic challenges, competitive pressures, and execution risks could all slow SoFi's path forward. For now, the debate continues. Will SoFi become one of the biggest fintech success stories of the decade, or will growth eventually slow down? Only time will tell. If you enjoyed this analysis, don't forget to like, subscribe, and let me know in the comments. Do you think SoFi can reach $50 by 2030? This video is for educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions.